Dickey here, and to give you an update on the market for the January 27th of 23. And I know the day's not over, but this should give us a pretty good idea. So as I was talking last week when I told you the stocks that I was looking for and the trends I was trying to find in those stocks, this is what I found in my opinion. Now again, I got my Excel spreadsheet up here that my son has a problem with, but again, it works for me. It's a pretty basic little thing. What we know from the markets are they're up roughly 3.76% this week on the NASDAQ, 2.37 for the S&P, and 1.83 for the Dow. Year to date, we're up 10.4 on the NASDAQ, 6 for the S&P, and then 2.58 for the Dow. The trends are continuing that I told you I wanted to see. And the trends need to be that the Dow's going up 1, the S&P's going up 2, Dow's going up, or NASDAQ's going up 3. We're not quite in that realm, but we're pretty darn close. I mean, you're up 2.58% in the Dow and you're up 10% on the NASDAQ. Okay, that's a little more than 3%, and it might vary a little bit. You're not up quite double on the S&P to the NASDAQ, but in that range. So again, we want to keep these going forward, which is going to, as we converge and we get the NASDAQ, the S&P, and the Dow back to their all-time highs, they should converge about the same time. More importantly, with the individual stocks that we found this week were Microsoft. Now, Microsoft, and I made a video on this. If you haven't had a chance to look at it, please look at it, because the idiots that talk about this stuff on television and write reports upon it, they're talking about it like, Microsoft's quarter was just this devastating quarter. It's the exact quarter we thought it was going to be, or at least I did. It was good, but not spectacular, but not bad. I mean, it's the old, right in the middle. Where everybody seemed to have a problem with it was how much money they were going to make going forward, their guidance. And the guidance was 50.5 to 51.5 billion, and the street wanted 52. And I'm here to tell you that if that's devastating or a horrible, I'm sorry, we just have a difference of opinion there. Which clearly what happened is as soon as the stock came out with its quarterly numbers, it's jacked up 5%. Then after the meeting, when they came out with the missing the 52 guidance, it went down 5 and then ended up the next day only down marginally, and it's kind of come back. Again, the market knows what they're doing. Please understand, follow what the market actually does rather than what's being said on television. But the more important trend that I found this week is that stocks that did well were promoted and they went up. The stocks that did poorly went down, rather than having the whole industry or sector being punished by one company. And that's really what we need to see. Now, whether you're an index person or whether you're an individual stock buyer, regardless, this is what you need to see for this to work right. What you don't want is what happened. Intel comes out yesterday, and truly, I mean, if you want to have a devastating quarter or a pathetic quarter or whatever you want to call it that they were saying Microsoft's was, Intel really was. Okay, we keep trying to find a bottom for Intel, but they keep digging the hole deeper. So I don't know what the problem is there, but clearly it's not a bottom. But Intel's problems don't necessarily mean they're the same as every other semiconductor in that space. You look at Levi Strauss jeans. Okay, it did very well this week. Came out with a fantastic quarter. Hasbro did not have a good one. Came down. So, but again, it's not bringing down the whole sectors. So this is what we really want to see. We want the market to look at it and go, hey, in general, roughly 78% of the companies that have reported have beat on earnings. Whether their earnings were lowered or higher, whatever. The simple fact is they're doing as good, if not better, than hoped, which I know going into this quarter was a concern, specifically on the bigger stuff. When you start looking at Microsoft, there was a lot of concern that was going to go down. So this week told us a ton of things. Hopefully this trend will continue as next week goes on, because next week's going to be a big deal. When you start dealing with, Powell speaking, and you've got Microsoft, or excuse me, you've got Apple, Amazon, Google, all reporting next week. A lot going on in next week. So we'll talk about that. And I've got a video coming up that'll tell you what I'm looking for in those things and those trends. But the trends I was looking for here are exactly what I'm hoping for in the stock market. Again, stock market, economy, two different things. But what I'm continuing to see in the stock market, and the way it's reviewing things, it's looking at things in a normal market way. Whereas a lot of last year, as you've heard me talk about, it didn't. You'd have in the beginning of last year, you had Nvidia come out and had great quarterly numbers, and it just tanked. It didn't matter what they did. It was going down 10, 15, 20%. And then every other semiconductor did the same thing. And not just semis. A lot of the different industries did the same thing. It didn't matter whether they beat guidance. It didn't matter whether they did this. It just got thrown out. Now, the other thing to think about and remember about what happened this week, we talked about Visa, MasterCard, American Express today. All of them have relatively high PE ratios. Again, I'm not saying that's good, bad, or indifferent, but when you listen to commentators and these people talking about it, they've all said that, well, you don't want to buy these things because the multiples are too high. They talk about the S&P being at a 17 multiple, and it's just too high, too high. Well, here's the problem. Visa, MasterCard, American Express are all above 17. I mean, Visa and MasterCard are in the 30s. And when come to task on it, and some of these people, when they're talking about it, people will ask them about, hey, Visa, MasterCard, well, they deserve the multiple. Well, now hold on a minute. What you said before is you can't invest in things that have high multiples. You didn't say unless they were deserving of it. Because again, as I've said before, if Visa is deserving of a higher multiple, why isn't Apple? Why isn't Google? Why isn't Microsoft? I look at those three on a daily basis and say, pretty much I use Microsoft, Google, and Apple, if not every minute of every hour of every day, pretty darn close. And I use my Visa and MasterCard or American Express or whichever one I use, not quite as much, but pretty consistently too. But if they're deserving of it, why aren't they? And again, I look at Microsoft and Apple and Google, and their PE ratios are lower than the others. And again, I'm not saying they're investable, not my point. My point is the inconsistency. If Visa's okay at 36 PE ratio, why isn't Apple at 20? Again, that's just the inconsistency part I don't understand. But the market itself is actually showing us the right answers. And so don't listen to what's going on in the news. Look at what the actual numbers are. The market is looking at this. The market is not. And I keep hearing this. Kramer was on yesterday saying, well, during earnings season, you don't listen to the Fed, you listen to the market. Well, a month ago, you were saying that, don't fight the Fed. Well, you either don't fight the Fed or you do fight the Fed. Which again, to me, it's not the Fed. The Fed is not our enemy. It is not our friend. The Fed is what it is. It's not part of the stock market. It is not part of the economy. It has its own job to do. Let it do its thing. The stock market will figure this out. Let it do its job. Follow what the stock market's telling you where to go and what to do, and believe in it. Now, you're going to hear some people say that the trends are too high. We're up 10% on the NASDAQ so far this year. Well, look at where you're at on the NASDAQ. You're at 11,100-ish, and I know the day's not over yet. But the all-time high is 16. So you've got a long way to go before you're even anywhere near the top. So just because you're up 10% doesn't mean that that's a big deal when you were down 36% last year. I'm just saying. The Dow's not near as far off on that, and the S&P isn't either. But there's still room to run. There's still, and again, I'm not saying it's going to happen today or tomorrow. I'm just saying to get back to their all-time highs, there's a decent distance there. So keep on looking at the trends. This is what I'm looking at. This is what it should be. And again, next week, even if it's 0.5%, 1%, 1.5%, or 0.1, 0.2, 0.3, what you're looking for are the trends and the fact that the NASDAQ and the Dow is doing better than the Dow and the S&P, because that's what has to happen here. And as long as those trends are continuing, to me, the underlying is going to work the way we want it to work. We're going to get back and have the Dow, the NASDAQ, and the S&P get to their all-time highs at the same time. So it should help everybody out that's doing stocks, and it should help everybody out that's using indexes and people that are using mutual funds, because they're all kind of tracking the same things. So keep focusing on it. And as I tell all my clients, I want you all to be able to retire when you want to retire and how you want to retire. Dickey out.